You've probably seen this set up on your charts before the price comes up, hits your stop loss, kicks you out of the trade, then moves exactly in your direction. Frustrating, right? But do you really understand what that means? Because this combination market structure and liquidity is literally the secret language that price speaks. It's what allows pro traders to enter at the perfect moment, right where everyone else gets trapped, and to catch trades with risk to reward ratios above 1 to 5, sometimes even 1 to 10. Today, I'm going to break down step by step how to understand market structure, how to spot liquidity, and most importantly, how to combine them to make precise and profitable entries. Stay until the end, because what you'll learn here can literally change the way you see the market. And don't forget to like and subscribe to support the channel. You know, before we even talk about strategy indicators or liquidity, we first need to understand the foundation of all trading, market structure. This is what shows you how price moves, and more importantly, which direction you should be trading in. The market doesn't move randomly. It always goes through three main phases: an uptrend, a downtrend, and a range or consolidation phase. The uptrend. When the market is in an uptrend, it means buyers are in control. Price keeps creating higher highs and higher lows. Each time the market pulls back a little and then pushes higher again, it's just continuing its bullish structure. As long as previous lows are not broken, the trend remains bullish. So as a trader, your main goal here is clear. Look for buy opportunities. The downtrend. Now, when the market is in a downtrend, sellers are in control. Price forms lower highs and lower lows. The market drops, pulls back slightly, and then continues going down. As long as a previous high isn't broken, the structure remains bearish. Here, your goal is to look for sell opportunities. The range or consolidation. Finally, there's the range, the phase where the market is neither going up nor down clearly. Price moves sideways between a support and a resistance zone. Buyers and sellers are balanced, and the market is breathing before choosing its next direction. During this phase, you can either wait for a breakout to join the next trend or scalp the range boundaries and buy low and sell high. In summary, market structure shows you where you are and what you should do. In an uptrend, look for buys. In a downtrend, look for sells. In a range, be patient or trade the edges. Because once you understand structure, you start to see the market like a pro. And that's when you can combine it with liquidity to make sniper entries with an insane risk-to-reward ratio. But in our case, we're not really going to focus on consolidation phases. Why? Because for our strategy to work properly, we need a market that's moving in a clear and defined direction. See, during consolidation, the market is basically undecided. Price moves sideways without any real intention. And this is where a lot of traders get trapped, because the market fakes moves up and down just to grab liquidity. That's why professional traders and even institutions usually stay away from ranges. They wait patiently for a clear breakout and a directional move before jumping in. What we're interested in are those directional phases when the market is clearly trending, either up or down. That's where the real opportunities are. That's where we can combine market structure with liquidity to find sniper entries with a high risk-to-reward ratio. So far, we've seen how the market moves, but there's one essential question left. Why does it move? Why does price rise at one moment and then drop sharply right after? The answer comes down to one word: liquidity. Liquidity is the fuel of the market. And if you want to understand the game institutions are playing, you first need to understand how liquidity attracts price. Let's break it down. What is liquidity? In simple terms, liquidity is the pool of orders sitting in the market. It's made up of all the stop losses, pending orders, and breakout trades that traders place. So every time a trader puts a stop loss above a high or below a low, they're actually adding liquidity to the market. And guess what? The institutions know that. They know where most traders place their stops. So instead of just entering randomly, they manipulate price toward those zones to grab that liquidity before moving in the real direction. How it looks on the chart. Let's say price is in an uptrend. Most retail traders will place their stop losses just below the previous higher low, thinking it's a safe zone. What happens next? The market suddenly spikes down, takes out all those stop losses, and then shoots right back up. That move wasn't random. It was a liquidity grab. The institutions needed those sell orders from stop losses to fill their buy positions before pushing the price higher. And it's the same thing in a downtrend. They push price a bit higher to hunt buy stops, then drop it to continue the move down. The real role of liquidity. Liquidity isn't the enemy. It's actually the target. It's where price is attracted before continuing in its true direction. So, when you understand how liquidity works, you stop getting trapped like the crowd, and you start trading with the institutions, not against them. In short, liquidity equals clusters of stop losses and pending orders. Price is drawn to these areas. Institutions use liquidity to enter big positions. After grabbing it, price usually continues in the intended direction. And that's exactly why combining market structure with liquidity is such a powerful approach. It lets you anticipate where price wants to go next before it even happens. Okay, now we know what liquidity is and why the market keeps reaching for those zones. But the real question is, how do we actually use that to make money? That's where the combination of market structure and liquidity becomes insanely powerful. And I'm going to show you, step by step, how the pros use it to take sniper entries with a crazy risk-to-reward ratio. All right, now we're getting into the real deal. The entry model I'm about to reveal to you is built around 3 powerful steps. Step 1, identify the market trend. Step 2, spot the liquidity zones. Step 3, find the institutional zone right above or below that liquidity. Let's break it down step by step. Step 1, identify the dominant structure. First thing first, look at your chart and identify the market structure. Go on a higher time frame, H1, H4, or even D1. The higher the time frame, the cleaner the setup. Now ask yourself, are we in an uptrend with higher highs and higher lows, a downtrend with lower highs and lower lows? Or just a range where price moves sideways? That's your foundation. Never trade against the market structure. Always trade with it. In this example, we're looking at a downtrend, so you can clearly see how the market builds its structure when price is moving lower. Once you've identified the market structure, it's time to move on to step 2, finding liquidity zones. On that same time frame, look for where liquidity is building up. These zones usually come in 2 types. Internal liquidity, which forms inside the move, often between 2 swings. External liquidity, which sits at the extremes, near the highs and lows of the swing. These are the areas where price loves to come back to, because that's where most stop losses and pending orders are waiting. Step 3, spot the institutional or confluence zones. Now comes the interesting part. Once you've found the liquidity, look just above or below it, depending on your trend. In an uptrend, focus below liquidity. In a downtrend, focus above liquidity. Inside these areas, look for institutional footprints, things like order blocks fair value gaps, or strong support and resistance zones. These are your high probability zones where institutions are likely to react and reject price. Execution time. Now you've got two options. Option 1. Enter directly with a limit order. Place your buy limit or sell limit right on your institutional zone. If the liquidity gets collected, your order triggers and price moves in your favor. Best possible entry, amazing risk to reward, but it's risky. Liquidity grabs can be brutal. Price might hit your stop before taking off. So here's option 2, wait for confirmation. Option 2, the confirmation entry. Let the liquidity be collected first. Then wait for a clear sign of reversal in your zone. That could be a wick rejection, a pin bar, an engulfing candle, or a retest of an order block or FVG. Once you see that, you take your entry with confidence. It's safer, cleaner, and gives you more control over your trade. The downside, sometimes your stop is a bit larger because of that long rejection wick, but it's worth it. The entry signal. After backtesting hundreds of setups, here's what works best. A rejection candle with a long wick that closes inside your zone, or a clear engulfing candle showing a shift in momentum. Stay on the same time frame you used to mark your structure and liquidity. Keep it simple. Stop loss placement. Your stop loss goes above the last high if you're selling, or below the last low if you're buying. Always give it a little breathing space to avoid getting wicked out. Take profits. For your take profits, set multiple levels. TP1, the next structural point or liquidity zone. TP2, a stronger area like an old support or resistance. Secure some profits at TP1, then let the rest run. That's how you build high RR trades without stress. Example, uptrend setup. In an uptrend, here's the flow. Identify the higher highs and higher lows. Look for liquidity below the lows. Wait for the stop hunt. That's the liquidity grab. Then watch for a rejection candle and enter buy on confirmation. The same logic works in reverse for a downtrend. Common mistakes. Don't sell in an uptrend just because you see a red candle. Don't use stops that are too tight or too wide, and don't skip confirmations. Patience beats impulse every time. Before you enter, quick checklist. Ask yourself, is the market structure clear? Have I identified liquidity? Is there a confluence, an order block, FVG? Has liquidity been grabbed? Do I have a clear confirmation candle? Is my stop loss and sizing correct? If all 6 are checked, take the trade. Final thoughts. Once you combine structure, liquidity, and institutional confluence, you stop trading randomly. You start understanding why price moves and where it's heading next. That's when you stop trading against the market and start trading with the institutions. This is how you take sniper entries, with confidence, precision, and control. Alright, that's the end of today's video. I hope it wasn't too long and that it helped you really understand how the structure plus liquidity strategy works. Don't hesitate to watch it again if you need to. The more you review it, the better you'll grasp each concept and the more confident you'll be applying it on your charts. If you found value in this video, make sure to drop a like, subscribe to the channel, and turn on the notification bell so you don't miss what's coming next. Thanks for watching, and I'll see you very soon in the next video.